Palo Alto Networks down about 5.5% after reporting earnings last night. What's going on with the stock? Is this an opportunity to buy? There seems to be some confusion on the financial reporting metrics. My name's Eric, your host, Mr. Fired Up Wealth. I'm going to break it down on this video today. Everything you need to know about Palo Alto Networks. Earnings highlights, valuation, commentary, and I'll even look at a chart, some technical analysis to give you some possibilities of where the stock might go. So the stock's actually down about 7% right now. At first glance, earnings were pretty strong. You look at the EPS, beat by 22 cents. Revenue of $1.9 billion, that's up 21.8% year over year. That beat by $60 million. One metric you look at with companies like Palo Alto Networks is going to be RPO, that's remaining performance obligation. That grew 26% year over year to $10.4 billion. That's a solid number. So you're seeing growth decelerate a little bit. That's part of it. Obviously, the stock has also ripped hard from recent lows, and that's also part of the sell-off as well. If you look at the fiscal year 2024, total billings, $10.7 billion to $10.8 billion, and that's going to be growth of about 16 to 17%, which is down from 2023. This company does have strong profitability. You look at the adjusted free cash flow margin, it's about 37 to 38%. Also has about $7 billion of cash on its balance sheet. So this is the 7th consecutive quarter of year-over-year margin expansion, underpins profitable growth. So we talk about the life cycle as a company. Go from spec, hyper growth, mature growth, DGIF, DGI, and then income stock. And this stock is really in that growth stage. So it's starting to slow down. When you look at the growth, it's decelerating a little bit, but that profitability is going up at the same time. And this is one of those companies you could easily see paying a dividend in the future. I'm not saying it's going to happen overnight, but you get several more quarters of profitability. There's going to be cash. Right now, you still want growth. You want the company to invest in infrastructure, acquisitions, M&A. So this company's doing well. It's important to understand where it fits on that spectrum within the growth of a company, the life cycle of a company. You look at revenue, 20% year over year, $1.88 billion. We talk about that RPO, 26%. That's positive. That's strong. Profitability improvements. You got operating income. That's up 64% year over year to $529 million. EPS, this is non-GAAP, $1.38. That's a 66% year over year improvement. And that free cash flow, 20% year over year on a trailing 12-month basis. And Palo Alto Networks has made some significant acquisitions. You think of M&A. They're doing a good job trying to get into that next-gen space, that zero trust security space. Growth and multi-module customers, 166% growth year over year. That's strong, 5+ modules here. And one last slide here and we'll move on. I want to make this rapid fire for you today. We remain focused on driving our 3-year strategy in FY24. So they just announced this 3-year strategy recently. They want to be an evergreen innovation company, make our platforms more comprehensive, leverage AI across the entire portfolio, also amplify our go-to-market to deliver our ambition, and be the best place to work in cybersecurity. And actually, real quick, this is important to look at. I want you to see the trend here. So total revenue, next gen security ARR. So this is going to be a little bit different company than, say, a CrowdStrike. CrowdStrike is going to be endpoint security, best of breed in endpoint security. Palo Alto Networks, they have their hands in a lot of different pots, and they're very strong in several areas. So we did a cybersecurity video, I think, last year talking about the top 10 cybersecurity stocks. Think about Palo Alto Networks. It has its hands on a lot of different pots, a lot of different segments within cybersecurity, and it's strong in many of those areas. When you look at, for example, revenue, it's a very different model than something like CrowdStrike that's built in the cloud for the cloud. So one of the focuses here, if you're an investor in Palo Alto Networks, is going to be in the blue here, next gen security ARR, annual recurring revenue. And you can see that growth is trending up nicely. And that RPO is important. We've heard that on several of these earnings calls this quarter. That RPO, that remaining performance obligation, $10.4 billion. And that number, 26%, but it's actually down. If you look at this, it was up 38%, 39%, 35%, 30%, and so on. So this number is still strong, but it's down when you look at the comparisons year over year. And then the total billings in the yellow, you can see a drop from Q4 2023 to Q1 2024. But still 16% year over year growth, but slowing down from these previous numbers. I think that gives you a great snapshot of what's going on. Now, at the same time, to be fair, you look at, this is GAAP earnings per share in the green, and you can see from 6 cents to 56 cents, this is trending up nicely, a little bit of a dip here again from last quarter. Okay, so part of the reason the stock is down 7%, Palo Alto's pullback on confusion around a key quarterly metric is a buying opportunity. This is according to CNBC. And I'll tell you my thoughts later if I think it's a buy buy or not and at what prices. This is something that's really important to focus on here if we're talking about earnings. This is the earnings transcript. I'm on Seeking Alpha. Can I go finance a 3-year deal? So Palo Alto Networks is going to have that annual recurring revenue that we talk about, like software as a service, but they also have 3-year deals. Now I'll hear from the CEO later. There was an interview last night, CNBC Kramer. I'm going to give you some segments and commentary on that, and you're going to want to see that part. This is talking about financing a 3-year deal with their $7 billion of cash. So very strong, $7 billion of cash and cash equivalents. But what I don't want to do is finance bad deals. A lot of times you see businesses where they'll do something they think is right for the customer. Like, for example, if they're not financing deals now and then they decide to finance those deals and they start getting some bad deals. This isn't a direct comparison, but let's just look at like an upstart, for example, carrying some of those loans on the balance sheet and what happened to the stock. Wall Street absolutely hated that. So this could be part of the sentiment as well. I think it's something to keep an eye on. And the CEO does discuss this later on that interview. You're going to want to stay tuned for that. Okay, and I will say this. If you're thinking about buying this stock or if you own it already, you need to listen to this earnings call. There's a lot going on. I could spend 2 hours just talking about this earnings call. A lot was covered, very deep information, very valuable information as a shareholder. One last thing I want to point out here from the earnings transcript. I think this is really important to understand too. So this is talking about how cybersecurity, cyber threats are at an all-time high. You're seeing a lot of cyber attacks out there. Every day you read about ransomware attacks. Now the SEC regulations are actually not kicked in yet. I think they kick in December. That's next month. But you're seeing some companies go out there and start to do sort of self-report in anticipation because they're all petrified, of course, when you get attacked. So here it is right here. New cybersecurity rules from the SEC will take effect December 15th, 2023. And it says, although the rules primarily target publicly listed companies, other private and smaller companies should familiarize themselves with the new rules. The SEC's cybersecurity rules adopted this past July require publicly listed companies to comply with numerous incident reporting and governance disclosure requirements. This is saying if there's any sort of breach that publicly traded companies are going to have to report it. And you do hear a lot in the news about breaches, but I can guarantee you don't hear about all of them, especially if they're smaller. If they're not impacting a large amount of customers, you probably don't hear about it at all. So what this could do, trying to look at the macro as an investor, we're looking at secular growth trends and we're looking at the macro and how that could impact those growth trends. There's going to be even more attention that's going to be focused on cybersecurity, more news, more drama, more publicly traded companies wanting to avoid and be out of the spotlight over it. What does that mean? Well, probably more spending in cybersecurity names. And just to be clear, the new rules here state that issuers must disclose cybersecurity incidents that are determined to be material by the company. Well, that's going to be a very gray area. What's material and what isn't. I think most threats probably are. Most attacks probably are material in some capacity. And so I think that companies are probably going to be safer than sorry, and they're going to over-disclose, I would imagine. If I were a CIO, that's the camp I would be in. It says that disclosures must be filed within 4 business days after a company determines that it has experienced a material cyber incident. And of course, critics argue that 4 days is not enough to confirm a breach, et cetera, et cetera. You could go down a rabbit hole with all these topics, but I want to bring it to your attention. Okay, so let's switch gears. This is Mad Money CNBC. You know the show. So the CEO says demand remains high despite quarterly weakness in billings. So this is talking about a weaker billings forecast than expected. The market was marginally spooked by the guidance, but has added that some clients pay annually as well as upfront for several years. So you got those 3-year contracts or you got the annual recurring, and hence the market's getting confused. Let's hear it directly from the horse's mouth. I'm going to show you some clips from the interview with Jim Cramer, Mad Money, and the CEO of Palo Alto Networks.
Welcome back to Mad Money. How should we be feeling about these numbers?
Thank you for having me, Jim. I'm surprised to hear you're confused. You're never confused. Jim, we had a great quarter. We beat almost every metric that was out there. Phenomenal profitability, phenomenal revenue growth in a market that is extremely volatile. I think the market is getting marginally spooked by the fact that we adjusted billings guidance down. I think it's important to understand. Look, our business is a hybrid of ACV and TCV, or people who pay annually and people who pay us upfront over 3 years. And as the interest rate environment continues to stay higher for longer, we're noticing that customers want to have longer conversations around when they will pay us and whether we should finance them or not. And this cosmetically impacts the billings number, and hence the market's getting confused. But there's nothing to be confused about. There's tremendous demand out there. Cybersecurity attacks are unfortunately going up. We've never seen a quarter as active as Q1 for us in the last 3 months, where people are seeing more attacks. We've never seen more customers sitting down and trying to derive platformization strategies. So the demand function is strong. Our revenue forecast has not changed. Our profitability forecast has gone up. So from our perspective, we had a great quarter, and the prospects are bright.
Nikesh, that would mean that the people who are selling the stock down 20 points simply don't understand how business is and are making a big mistake. At the same time, the crowd is rarely as wrong as that. And I think some people feel that this was just a light number and that you have some problems, say, with firewall business that are similar to Fortinet. And that what really is going on here is that it's just getting harder and harder to close deals in a business that it shouldn't be because it's cybersecurity.
Well, I think, Jim, we should parse that a bit more. We have been very consistent in the last 12 to 18 months saying that we expect that the hardware business or product business out there is growing at 0 to 5%.
Right.
We did 3% growth. We've been very consistent. There are people out there who show larger numbers, and I'm going to show smaller numbers.
So this is what I was talking about earlier. This is a lot different company than, say, a CrowdStrike. This business has a medley of products and services. We're talking about 3% on firewall. And this is part of the reason that Fortinet had a bad quarter, was selling off pretty hard, some weak numbers there. Anytime you have hardware in the mix, it creates a completely different element with the business. When you think of just a pure SaaS model, CrowdStrike, Zscaler, Datadog, so on, they are very different businesses. And I would argue that those businesses are a little bit different on that spectrum we talk about. So I would personally classify the Datadogs, the Zscalers, and the CrowdStrike towards the end of the hypergrowth cycle, going more into growth. And I think Palo Alto Networks is more in the growth, kind of midway through that, working its way more to mature growth as the numbers start to decelerate, as that growth starts to slow down.
Down the middle, we managed to make sure that we manage our price hikes, we manage our supply chain, we manage our backlog in such a way that we can consistently deliver that. So I don't think the hardware woes of other people in our industry are pertinent to us. I think from a customer deal perspective, as I said, we have the ability to finance deals. We have $7 billion of cash on our balance sheet, so we can finance deals. I'm telling you, we don't have customers who are saying we don't want to do business. It's just that.
The question is as a shareholder, do you want them to finance deals? Of course, you can make money. You can make significant money off that $7 billion in cash, but it also adds an element of risk for defaults and things like that. Now, I will say that Palo Alto is generally going to be focused on larger customers, and that's probably less of a risk. When you think of something like we mentioned Upstart, we're talking about, B to C, right? You're talking about business to consumer customer, not B2B. This is B2B and mostly enterprise focused larger businesses. So you have to keep that in mind as well.
And here's an interesting metric. Our duration has gone down this quarter from last quarter, which means our deals are shorter. When deals are shorter, you get lower billings. Doesn't mean there are less deals in the market. You're still doing the same amount of business, saying, and my churn is low, so I don't mind it.
And the deals are getting shorter. I think part of it is anticipation and preparation for these new SEC rules.
I'll sign up for 1 year, I'll come back later. I'm like, no problem. You'll be there next year.
I have an idea. Okay, so I see you bought back $67 million worth of shares last quarter, $227. You've got a gigantic amount of cash. Maybe this is the opportunity to show the people who are just throwing their stock away because they do not understand what you just said, that, you know what? Here, sell it to me. I got all the capital. You went out of my stock. I think that's terrific. I don't want you as my shareholder if you don't understand what I'm doing.
I actually get the sense from this interview that the CEO is somewhat annoyed by Jim. Maybe it's just me, and that's how I'm interpreting it. But it's pretty funny. Watch the body language.
Well, Jim, we have an evergreen stock buyback approval from our board in the vicinity of $1 billion. And our treasury team is very diligent about how they look at the market, and they will opportunistically see.
So $1 billion share buyback repurchase program.
When they believe that we should be in the market, and they'll do what is needed.
Fair enough. Okay, so let's talk about the threats. We've got, by the way, we have President Xi here right now. I mean, does that mean that China's not a threat because he's here? And how about what's going on in the Middle East? I mean, it would seem to be that this is the greatest disruption. And then tell me what happened at Clorox. Tell me what happened at the casinos. Because it seems to me that, I would pay you anything if I ran a business right now and I was worried about cybersecurity.
Well, Jim, all I will tell you is that the cyber activity is so high that we got the most number of calls to our incident response team in the last month than we've ever had at Palo Alto Networks. And we're not the biggest player in incident response, so I can only imagine what some of our other peers in the industry are seeing from an incident response activity. Yesterday, we announced a program that for our top 2,000 customers around the world, we will give them free incident response if they get attacked.
Free incident response. There you go.
We have shown the biggest collection of cash this quarter, close to $1.5 billion. We have shown revenue growth north of 20%. Our EPS, we have shown operating margin of 28.4%, which is 760 basis point improvement from last year. So we are hitting all the profitability and cash flow metrics in the market. Billings is an indicator of revenue in the future. And the better indicator of revenue in the future is RPO, remaining performance obligations, which we grew at 26%.
Okay. 26%, and that number is good. And I'm not taking it away from it, what he's saying there at all. Back to this slide though, 26%, and that's good, but we had 38%, 39%, 35%, 30%. This number is still strong, and it's obviously 10.4 billion is still more than 8.3 billion, 8.8 billion. The company's doing just fine, but growth is slowing down a little bit. Not that the growth is bad, but it's just part of that whole life cycle of a business. This is becoming more profitable. It's more attractive to more investors. And this type of market, you've got a secular growth trend with cybersecurity. You got a company that has very strong profitability metrics. This is going to be very much in fashion. And the stock's probably going to go higher with time, even though it has this short-term dip today. And we'll look at a chart here in a couple minutes. Stay tuned for that.
I absolutely agree with you. That's how I've always...
It doesn't take a math wizard to figure out what's going on.
I've learned that in the last 2 years, so perhaps I'm a little less confused after I've been speaking to you. Fair enough? Thank you. That's Nikesh Arora, Chairman and CEO of Palo Alto Networks, PANW. The stock is down. You just heard another version.
Did you see his face? I don't know. To me, it seemed like he was annoyed in that interview. Maybe I just read it wrong. All right, investing aliens, let's get to work. So right now, stock's down about 7%. If you look at this, though, 52-week range, $132 stock, January 12th of 2023. 52-week high, 265, just happened here on October 13th. So this is showing 145.27 PE ratio. This is going to be 12 months trailing, $79.62 billion market cap. Of course, it doesn't pay a dividend right now. So of course, the analysts, they are going to be updating their price targets. You've got BMO Capital, maintains outperform, lowers price target to 283. You got RBC Capital, reiterates outperform, maintains $281 price target. Wedbush, $290 price target. Of course, you don't buy a stock off of these analyst price targets. These are generally 6 to 12 month price targets, but I think it's interesting just to look at to give you an idea of the sentiment of the market and how analysts maybe interpreted the earnings call. JP Morgan raises price target to 272 from 268, a whopping $4. And maintains overweight, and you get the idea here. Raymond James, Palo Alto 260 from 250, maintains outperform. Wells Fargo $280, and so on. Okay, so year to date, stock is up 72%. Over 1 year, it's up 46.93%. Over 5 years, it's up 322%. And over 10 years, it's up 1,480%. Look at the valuation, and this is on Seeking Alpha. You don't buy or sell a stock just based solely on these rankings, but they're good to look at. Seeking Alpha is going to give the valuation an F. Of course, you have to make sure you understand each stock because it's using these grades and taking all stocks kind of in one pool. It's not taking into account recurring revenue and RPO and all those different things, right? But just to get an idea, the PE ratio, according to this here, TTM is 200. We just saw 149 on Fidelity. Of course, this is probably going to be updated from earnings this being last night. The gap forward PE, 113. So if you're using PE ratio, which I wouldn't recommend using just the PE ratio to buy a stock, you're going to see that the valuation on this is pretty high. But of course, again, you're not going to use just the PE ratio on a company like this before you buy a stock. It's just going to be one tool in the tool belt or that toolbox that we talk about in Fired Up Wealth. On the growth side, strong 25% revenue growth year over year. Forward is 20%. I'll talk more about this in a second because it's revised down slightly. Where you're really going to see some strong numbers, you think of like EBITDA growth, 1,778%. These profitability metrics are pretty strong. It's A+ on the profitability according to Seeking Alpha. That gross profit margin, 72%. Return on common equity, TTM, 44%. You can see the numbers on your screen. So Seeking Alpha is saying the valuation's an F. It's too expensive. Growth is a B+. So again, It's not hyper growth. It's a growth stock, right? It's not really in hyper growth. It's more in that growth stage. Profitability, it's getting more profitable. It's got pretty good momentum. You look at this as kind of a market leader, especially you look at cybersecurity names. Okay, so in a nutshell, Palo Alto, basically you're showing a downward from 19 or 20% to 17% for that billings growth. So you're seeing a bit of deceleration, especially look at that guidance. From a leadership perspective, I think that Palo Alto Networks has a strong leadership team. I think it's managed well. The company's been doing well. And I really like how the company has pivoted more into that next gen security, done some mergers and acquisitions to be relevant in certain areas. They've done a really great job if you look at the history of the company over the last 5 years. Looking at the valuation, another metric you can look at is something like a forward EPS. And I think it's around a 43, I think is the number on the forward EPS. So 43x forward EPS, you could argue that that's still attractive, I guess, depending on the type of investor you are and what you're going for, what your goals are with the portfolio. If you're someone that's a value investor, something like this is just never going to make sense because you're going to want the P ratio to be, 15, and it's just not going to happen until it's more of a mature company. When you get these growth companies that still have, lots of room for growth, there's going to be a premium baked in, especially the higher the quality company, the higher the quality of the balance sheet and the metrics that we just looked at. I think you will see this company continue to do well over the next several years. One question I would have is, did we have some pull through because of these SEC regulations? It could just be me overanalyzing, but will you see even more of a slowdown or maybe a miss on some of these companies? I honestly think that this trend is still in fairly early to mid stages. You're going to see a lot of companies spend more money on cybersecurity, especially as you see more and more threats. And I think especially as you see SEC regulations being more scrutinized, more visible, this is probably a good time to get into the stock. We'll look at a chart here next, and I'll show you what I think in terms of the possibilities. Now, when I say it's possibly a good time to get in the stock, I'm not saying that this is a great price or that it's cheap here. In fact, if you look at this, the target was always $140 to $150 in Fired Up Wealth. We had a double bottom here. And last year in 2022, we were saying, if it gets under $150, especially around 140, it's a good opportunity for a long-term investment. So the Fired Up Wealth buy target recommendation was, $140, $150. Now it's $239, and it was up even higher at $285 a share. So of course, it's much better if you buy here, but you can't go back in time. Will we see these lows again? Probably not, unless you see the whole market collapse and we have a bear market, then you'll see these prices again. And that's an area probably to add the stock. If the market remains bullish and we don't go into a recession, well, this is what we're dealing with, right? This S3 is at $210 down here, and this 200-day moving average is a simple moving average in purple. That's going to be closer to $219, $220. So orange is previous chart day. Yellow is going to be today's chart day information I drew up today. We do chart day every single Wednesday in Patreon Discord. In fact, we do live streams every Monday, Wednesday, and Friday at 9 a.m. Eastern, and those are recorded. If you're interested in joining our private community, check out patreon.com/firedupwealth. And I've got a couple more thoughts here on the chart here, but I need to get this in as well. I am an affiliate with Seeking Alpha. And so basically I've got a link, and if you're going to sign up, you use the link, you get a deal on the price, and I'll make a few dollars. I'm not being paid per video or anything like that. It's just affiliate sponsorship. So if you're going to sign up for Seeking Alpha, there's a Black Friday deal right now. There's a link in the comments and in the description of the video below. Click that, the Fired Up Wealth exclusive link, and there's an offer there for you. Go check that out if you're looking to sign up. Final thoughts here on Palo Alto Networks. I like the company. It's not my favorite cybersecurity name necessarily, but if you're going to buy one cybersecurity stock or company that fits lots of different segments, this is really your huckleberry. I like buying best in breed, best of breed in different segments. So I own things like CrowdStrike and Zscaler, and you know what I own. I like this company a lot, and I do own quite a bit of this indirectly through cybersecurity ETFs. One that you can check out is the Wisdom Tree. WCBR is the name of that, or the ticker of that ETF. For me, if I were buying this stock and I didn't own it, it's probably getting attractive here in this pullback. If you look at the kind of the trend line here, I would really like to see it come down to the 200-day moving average, which is also in this trend line right here. And it might not happen. And that's the problem. When a stock is in high demand, it's high quality. Overall, it was a pretty good report. The market's been fairly bullish the last several days. You might not see it go lower. But if I'm being disciplined, this is really the area that I'd want to focus on, probably closer to $220 a share. And so if I'm DCAing maybe 225 to 210 would kind of be that sweet spot in that range. I wish I had a crystal ball to tell you exactly where it'd go. It probably holds up kind of where it's at. You know, right now it's at $239. You can see it actually dipped down even lower than that. It was $234. So you do have buyers coming in. You can see this is a daily candle and this is the bottom wick. You do have buyers coming in. This stock is in high demand. It's very fashionable. It's got the metrics that Wall Street is looking for in this type of environment. So it probably holds up. But what I'm saying is my preference is if it did come down in here, I think this is where it makes sense to buy if I don't own any shares. If you really like the company, you probably need to nibble some shares in this range. And then if it comes down lower, you DCA more shares. I hope this video is helpful, guys. I've been trying to mix up videos. This is kind of getting more back to the roots, a little bit deeper dive, going a little bit more depth. The reality is there's only a fraction of YouTube that are investing aliens. If you're watching right now, you are an alien. And if you're watching right now and you're an alien, you should consider joining our private community. Again, check it out, patreon.com/firedupwealth. I have a 1-week free trial. Cost you $0 to go give it a try. You can even get into Discord, see everything I'm buying in my portfolio, what the team's buying. You can see everything for free, so you got nothing to lose. Go check that out. If you're new here, subscribe to the channel, click that bell for notifications. If this video is helpful, drop me a like, drop me a comment. Have a great rest of your day. Take care.